In January 2024, BlackRock launched a Bitcoin ETF. Within 48 hours, it attracted $1 billion in assets, the fastest ETF launch in history, and by February 2026, that number hit $62.5 billion, making BlackRock the largest institutional holder of Bitcoin on Earth. But here's what nobody's connecting. This isn't just about Bitcoin. BlackRock CEO Larry Fink didn't wake up one morning and decide to embrace crypto on a whim. He's systematically restructuring the global portfolio model that's existed since the 1950s, and Bitcoin is just one piece of a much larger strategic shift. If you want to understand how the world's largest asset manager is repositioning $11.6 trillion in client money for a post-dollar dominance era, subscribe to The Econaut, because we examine the structural forces driving capital allocation that financial media won't explain. The traditional investment portfolio was 60% stocks, 40% bonds. Simple, balanced, worked for decades when bonds reliably moved inversely to stocks. When stocks fell, bonds rose, providing protection. But that relationship broke in 2022, and it hasn't recovered. According to BlackRock's own analysis, the 12-month rolling correlation between stocks and bonds hit levels not seen since the 1970s, meaning both assets now move together during crises. When inflation surges or Fed policy shifts, stocks fall and bonds fall simultaneously, destroying the diversification that made 60/40 work in the first place. So in his 2025 annual letter to investors, Larry Fink declared the 60/40 portfolio may no longer fully represent true diversification. Instead, he proposed 50-30-20, 50% stocks, 30% bonds, 20% private assets like real estate, infrastructure, and private credit. And this isn't a suggestion. It's a blueprint for where BlackRock is moving client capital right now. Private markets, assets you can't buy on public exchanges, are projected to grow from $13 trillion today to over $20 trillion by 2030, according to BlackRock's Private Markets Outlook. That's a 54% increase in 5 years, driven by pension funds, insurance companies, sovereign wealth funds, and increasingly, retail investors through new fund structures that didn't exist a decade ago. But private assets require one thing: long-term commitment. You can't sell infrastructure or private credit overnight like you can stocks or bonds, which means investors need to believe these assets will outperform traditional portfolios over 10-year horizons. And BlackRock is betting they will because of one structural force reshaping the global economy: AI infrastructure buildout. Data centers powering artificial intelligence consume exponential amounts of energy and require massive physical infrastructure. BlackRock's 2026 outlook projects AI-related capital spending could reach $5 to $8 trillion between 2025 and 2030, with infrastructure investment alone contributing 3 times its historical average to US GDP growth. This isn't speculative tech. It's roads, power grids, real estate. Specialized properties like data centers, life sciences facilities, and logistics hubs are becoming core infrastructure. And unlike public stocks, these assets generate revenue through long-term contracts tied to inflation, meaning they protect purchasing power in ways bonds no longer do. Infrastructure historically offers low correlation to traditional markets, stable income, and inflation protection, which is exactly what investors need when stock-bond correlations have broken down. BlackRock's analysis shows even a 10% allocation to infrastructure historically boosts portfolio returns while reducing volatility. So that's private assets. But where does Bitcoin fit? On December 23rd, 2025, BlackRock named its spot Bitcoin ETF one of the 3 biggest investment themes for 2025, alongside treasury bills and US megacap tech stocks. Not gold, not commodities, Bitcoin, positioned as a strategic portfolio component on par with the safest and most dominant assets in global markets. And the data backs this up. IBIT attracted $25.4 billion in net inflows during 2025 alone, despite Bitcoin's price falling 9.6% that year, making it the 6th largest ETF by inflows across all asset classes And here's the critical detail. It was the only top 25 ETF with negative returns. Bloomberg ETF analyst Eric Balchunas called this a HODL clinic, meaning investors weren't chasing momentum. They were buying and holding through volatility, behavior typically seen with long-term strategic assets, not speculative trades, and approximately 50% of ABIT demand now comes from retail investors, with 75% of those being first-time iShares buyers. But the real signal came from institutional allocations. Sovereign wealth funds from Abu Dhabi, Mubadala Investment Company, and Al Wada Investments accumulated over $1 billion in IBIT holdings by the end of 2025, adding 4 million shares during Q4 even as Bitcoin's price fell. Hedge fund billionaires followed. Paul Tudor Jones increased his IBIT position 82%, making it his largest holding excluding options. Israel Englander of Millennium Management added 6.3 million shares. David Shaw increased his position 345%. And these aren't retail speculators. These are institutional allocators who manage hundreds of billions, deploying capital with 10-year time horizons. And then there's Larry Fink's language shift. In 2017, he called Bitcoin an index of money laundering. By 2024, he's calling it digital gold and the digitization of value, explicitly framing Bitcoin not as risk-on speculation, but as a hedge against sovereign debt debasement and currency instability. This matters because BlackRock doesn't move $11.6 trillion in client assets based on CEO opinions. They move based on structural analysis, and their thesis is straightforward. Bitcoin's fixed supply of 21 million coins makes it the only major asset immune to monetary debasement, and in an era where US debt exceeds $38 trillion, with interest payments approaching $1 trillion annually, that scarcity has fundamental value. But here's where it gets more interesting. BlackRock isn't just buying Bitcoin. They're building infrastructure to integrate it into traditional finance, and that infrastructure changes everything. In 2026, Wells Fargo began accepting Bitcoin ETF shares as eligible collateral for US dollar credit lines. This means clients can borrow against their IBIT holdings without selling, treating Bitcoin with the same financial utility as blue chip stocks or treasury bonds, and JP Morgan and BNY Mellon have operationalized similar lending desks. This is Bitcoin's reclassification from speculative asset to Tier 1 collateral, something that would have been unthinkable 3 years ago. And BlackRock accelerated this by filing for a Bitcoin Premium Income ETF in January 2026, a fund that generates yield by selling covered call options on Bitcoin holdings, creating income for conservative investors who want exposure without maximum volatility. So now BlackRock offers 3 distinct Bitcoin products: IBIT for direct price exposure, Ether for Ethereum smart contract exposure, and Premium Income ETF for Bitcoin yield strategies. This isn't a single bet. It's a diversified crypto infrastructure mimicking traditional asset class segmentation. And beyond Bitcoin, BlackRock launched BUIDL, a tokenized money market fund holding $2.85 billion in assets across Ethereum, Solana, Polygon, and other blockchains. Qualified investors purchase BUIDL tokens backed by US Treasury bills and overnight repos, earning 4 or 5% APY distributed daily as new tokens. Binance, Crypto.com, and Deribit now accept BUIDL as collateral for derivatives trading, and Ripple integrated it into treasury platforms for enterprises. BlackRock earns management fees while investors capture yield, and BUIDL has distributed over $100 million in dividends since inception. This is traditional finance infrastructure being rebuilt on blockchain rails, and BlackRock is leading that integration, not because they love crypto ideology, but because tokenization offers operational efficiencies, 24/7 settlement, programmable compliance, and global access that legacy systems can't match. Now the question, is BlackRock selling the dollar? Not literally. They're not dumping treasury bonds for Bitcoin overnight, but they are de-emphasizing traditional dollar-denominated bonds in favor of assets that don't rely solely on dollar stability: private infrastructure, real estate, Bitcoin, tokenized treasuries. The 50-30-20 model reduces bond allocation from 40% to 30%, and that missing 10% shifts into private assets and alternatives. For a $10 trillion portfolio, that's $1 trillion reallocating away from traditional bonds. And when the world's largest asset manager publicly declares bonds may no longer fully represent true diversification, that's a structural signal. And it's not just BlackRock. According to the data, households held nearly $20 trillion in cash and liquid assets in mid-2025, and they allocated more to cash than stocks or bonds over the previous 3 years, suggesting investors are waiting for clearer signals before committing. BlackRock is providing that signal by repositioning client portfolios toward assets with inflation protection, low correlation to traditional markets, and structural scarcity. Bitcoin checks all three boxes, as does infrastructure and private credit. And the combination offers diversification that bonds alone can no longer deliver. The timeline matters. IBIT launched January 2024, less than 3 years from now. In that time, it became the fastest growing ETF in history, accumulated $62.5 billion in assets, positioned Bitcoin as institutional grade collateral, and normalized crypto exposure for pension funds and sovereign wealth funds. Wall Street analysts project Bitcoin could reach $200,000 by 2025, according to Standard Chartered and AllianceBernstein, $7,000-$10,000 by 2030 per ARK Invest, and potentially $1 million by 2033. These aren't fringe predictions. They're coming from major financial institutions analyzing supply-demand dynamics and institutional adoption curves. And Michael Saylor, executive chairman of strategy, projects Bitcoin becoming a $200 trillion asset by 2045, implying 9,400% upside from today's $2.1 trillion market cap. Whether those targets materialize depends on sovereign adoption, regulatory clarity, and macroeconomic conditions, but the institutional infrastructure is now operational. BlackRock holds $755,000 Bitcoin through IBIT as of February 2026, representing approximately 3.6% of Bitcoin's fixed 21 million supply. Add BlackRock's 5% stake in Strategy, which holds 673,000 Bitcoin, and they have exposure to over 1.1 million Bitcoin, roughly 5.2% of total supply through combined direct and indirect holdings. For context, if Bitcoin reaches even $200,000, BlackRock's IBIT holdings alone would be worth $151 billion. At $500,000, $377 billion, and these numbers don't include appreciation in private assets, infrastructure, or real estate, simultaneously gaining value as the AI buildout continues. So, is this a bet against the dollar? Not exactly. It's a bet that dollar-denominated bonds won't protect portfolios the way they used to, that inflation will remain structurally higher than the 2010s, that fiscal deficits will continue expanding, and that assets with intrinsic scarcity or inflation-linked revenues will outperform fixed income securities over the next decade. BlackRock isn't abandoning dollars, they're diversifying away from dollar dependency. And when the world's largest asset manager makes that shift, it accelerates trends already in motion. Central banks buying gold at record rates, oil producers accepting yuan for settlements, BRICS nations building alternative payment systems. BlackRock's strategy doesn't cause de-dollarization, but it reflects institutional recognition that dollar dominance is no longer guaranteed, and portfolios need to adapt accordingly. Private assets offer diversification, Bitcoin offers scarcity, and both reduce reliance on traditional bonds backed solely by government promises to manage debt sustainably. The 60-40 portfolio worked when the US ran budget surpluses, inflation stayed under 2%, and bonds reliably offset stock volatility. None of those conditions exist today, and BlackRock is restructuring for the world as it is, not as it was. This is happening now. IBIT inflows in 2025 exceeded $25 billion. Despite negative returns, institutional holders increased positions during price declines, sovereign wealth funds allocated over $1 billion, and billionaire hedge fund managers made Bitcoin their largest holdings. And while Bitcoin grabs headlines, the larger shift is private markets growing from $13 trillion to $20 trillion by 2030, with infrastructure and private credit leading the expansion. BlackRock isn't just buying Bitcoin, they're rewriting the rules of portfolio construction for an era where traditional diversification no longer works. The question isn't whether BlackRock is right. The question is whether you're positioning for the same structural shifts they're preparing their $11.6 trillion in client assets to navigate. Because when the world's largest asset manager says the old model is broken and builds entirely new infrastructure to replace it, that's not speculation. That's a reallocation happening in real time.